Welcome to the Stock Market Palantir. Today we are going to talk about PSNY. So we are diving into Polestar Automotive. And this is a company that, it genuinely presents one of the most compelling and frankly confounding investment thesis in the entire EV sector right now. As of late 2025, PSNY is trading in deeply distressed territory, bouncing between 50 and 60 cents per share. Now, a valuation like that, it implies one of two things: either impending insolvency or just a complete lack of faith in their business model. But, and here's the paradox, the company has delivered really robust operational growth, reporting a 49% year-over-year revenue increase in the first 9 months of this year. So this massive disconnect forces the central question we have to tackle. Is Polestar a profoundly mispriced asset, poised for a violent repricing? Or is it a classic value trap, destined for a cheap privatization by its parent, Geely? I'm going to contend that their successful execution of a major operational and geopolitical pivot, it sets the stage for exponential upside in 2026.
And I come at it from a completely different angle. While that 49% top-line growth is, you're right, it's absolutely undeniable, and certainly a testament to product demand, the market is fundamentally ignoring growth metrics. It's pricing for one thing and one thing only: solvency risk. My perspective, based on the material, is that Polestar remains an untenable long-term investment for minority shareholders. The company is just defined by severe financial distress and structural weaknesses that I think negate those positive operational narratives. The story you're telling suggests this: operational phoenix rising from the ashes. But the core financials, they just scream value trap.
Okay, but let's focus on that pivot, because it's the key. It's the key to neutralizing the downside. Polestar has successfully executed a critical, truly life-saving operational shift by moving manufacturing capacity out of China and into the United States. Commencing Polestar 3 production in Ridgeville, South Carolina, is perhaps the single largest bullish catalyst for this company's medium-term outlook. This move fundamentally alters their unit economics. First, they immediately avoid the punitive 100% U.S. tariffs that are now being levied against Chinese-manufactured EVs, tariffs that would make them non-competitive overnight.
Sure, that tariff point is certainly valid, but avoiding tariffs doesn't generate profit. It just mitigates a massive loss.
No, but it does more than that. This South Carolina production allows Polestar to leverage the Inflation Reduction Act in a specific, crucial way. They gain access to the IRA's lease loophole through the $7,500 commercial clean vehicle credit. This is important because the P3 doesn't qualify for the consumer credit due to component sourcing rules, but it does qualify for the commercial credit if it's leased. So this structure lets Polestar offer highly competitive lease rates, effectively subsidizing the consumer cost and enabling them to compete head-to-head on price with luxury rivals like the Cadillac Lyriq. That's a game changer for moving volume and improving margins.
It is a clever mechanism. I'll give you that. The lease loophole is strategically brilliant. However, I would frame the financial results very differently. The market is ignoring this geopolitical pivot because, frankly, financial distress is paramount, and the Q3 2025 results show a fundamental degradation that I think breaks the investment thesis, irrespective of where the cars are built. We saw adjusted gross margin plummet to a staggering negative 7.9% in Q3. That is a massive deterioration from negative 1.2% just a year prior. And while you cite the revenue growth, the net loss for the 9-month period, it widened drastically. It almost doubled to $1.558 billion. This is proof their cost structure is bloating, not leaning out. Operating leverage is completely broken right now.
Okay, I see why you're fixated on that Q3 margin print. It was ugly, no doubt. But let's be precise about why it was so negative. A significant portion of that negative margin was driven by two things. First, the restructuring costs that are associated with shifting manufacturing and logistics for the P3, and second, hefty adjustments related to residual value guarantees on existing leases. These are backward-looking costs. They're temporary, tied to the pivot itself, not necessarily some core operating failure.
I'm sorry, I just don't buy that it's all temporary. The fact they had to rely on $123 million in carbon credit sales just to optically cushion those gross margin figures, which still ended up negative 7.9%, is a major, major red flag. It suggests the underlying vehicle economics are actually worse than advertised. And this brings us directly to the core tension you mentioned, the asset-light model itself.
Agreed. Let's dig into that. We have to analyze whether the asset-light model is a structural advantage or, as you're implying, a structural weakness.
I argue it has become margin light. Polestar is contract manufacturing, right? They're using Geely and Volvo facilities. This arrangement forces Polestar to pay a transfer price for every single vehicle, and that price already includes a built-in margin for the factory owner, Geely or Volvo. So Polestar is effectively buying finished goods from its own parent. When pricing power erodes, as it clearly has throughout this EV winter, Polestar has no capacity to squeeze factory efficiencies because they don't own the plant. They are forced to absorb all the discounting on the retail side, while that fixed transfer price acts as a hard floor on their costs. That is the mechanism that led directly to the devastating Q3 gross margin. They've surrendered control over their cost base.
That's a compelling and, yes, a technically precise argument on the transfer pricing constraint. But you are neglecting the immense benefit that they got from this strategy, and that's speed and capital efficiency. The alternative to asset-light is, well, it's asset-heavy. It means burning tens of billions of dollars to build your own gigafactories. The asset-light model allowed Polestar to rapidly develop and launch multiple complex vehicles, the P2, P3, and P4, and get them to market much faster than any traditional startup. That capital efficiency and development is invaluable. To build the capacity for just the P3 and P4 would have required sinking another, $4 to $6 billion? Money the company simply didn't have and couldn't raise.
Capital efficiency doesn't matter if the company goes bankrupt because it can't cover its operating expenses.
I maintain that the margin compression is temporary. It's linked to the restructuring and the delayed P3 launch, which is now resolved with Ridgeville production coming online. The key is what happens when volume ramps up. The costs are incurred now, but that operating leverage, it returns in 2026 once the Polestar 3 and the critical high-volume Polestar 4 truly begin to scale.
I admire the forward-looking vision, I do, but execution has to be funded. And that brings us to the most immediate and defining problem, liquidity. Financial reality trumps product hope right now. Let's just look at the balance sheet. Cash stands at $995 million as of September 30th, against a quarterly net loss of approximately $365 million, and that's a conservative loss calculation. We are looking at an operating runway of fewer than 3 quarters without more financing.
But they have secured financing.
Yes, but raising external capital at 60 cents a share is ruinous. To raise, let's say, $500 million, they'd need to issue nearly 1 billion new shares, pre-split. This just leads to massive, value-destroying dilution for existing shareholders. And that is why the primary risk here is the take-under scenario. Geely, the 38% owner, they don't want Polestar to fail, but they certainly wouldn't mind buying it cheaply. They can just privatize the company, offer $1 or $1.50 per share, wipe out the retail holders, and capture all that future upside for themselves. Their interests are not perfectly aligned with minority shareholders.
I agree on the risk of misalignment, but I am not convinced that insolvency is imminent, precisely because Geely and Volvo are actively underwriting their survival. This isn't some typical distressed startup left to wither. The company secured a substantial $950 million loan facility from a syndicate of 12 international banks. Banks don't lend nearly $1 billion to a company they think is 3 quarters from collapse.
They're lending because Geely and Volvo are standing in the background.
Precisely. And crucially, Volvo extended its shareholder loan maturity out to June 2027. This consistent, multi-layered financial support acts as a survival guarantee. It prevents that immediate insolvency and buys them the time they need to execute the P3 and P4 launches through 2026. And look, that $200 million equity injection from PSD Investment, Eric Lee's affiliate, back in June, even if it was dilutive, was a necessary vote of confidence. It shows that when they absolutely need it, they still have access to capital.
But that reliance on debt and the controlling shareholders' capital, that introduces what we call the Geely discount. The market heavily discounts companies where the controlling interest can dictate terms that hurt minority holders. Let's move to market mechanics, because that often dictates the price of these assets regardless of fundamentals. I believe the structure of the stock itself is impairing your bull case.
Go on.
We have the impending 1-for-30 reverse stock split scheduled for December 9th. Now, while it's necessary to regain NASDAQ compliance, historically, this maneuver creates what's often called a death spiral. We only need to look at a company like Nikola. A reverse split often leads to more selling pressure post-split because institutions and ETFs, they just dump the shares. The split is seen as a sign of desperation. The share count shrinks, but the market cap keeps falling.
That assumes the split is purely defensive. I believe the choice of the 1-for-30 ratio is actually a strategic move that gives them upside.
How? It seems excessive.
At the current, say, 55-cent pre-split price, that creates a post-split price of around $16.50. Management chose that high ratio deliberately to create a massive buffer. It permanently removes the existential delisting narrative from the discussion for years. By taking that fear off the table, it forces investor attention back onto the fundamental product pipeline where the real value lies. The market needs to stop trading Polestar like some OTC stock waiting to be delisted, and this split achieves that.
I disagree that it solves the underlying mechanical issues. Let's talk about the trading environment. We have seen a pervasive anomaly here. 70% dark pool trading volume. This indicates that market makers are internalizing the vast majority of retail buy flow. They are executing these trades away from the lit exchanges.
And why is that relevant to the fundamental valuation?
Because the entire mechanism works to suppress upward volatility. When a retail investor places a buy order, if it's internalized in a dark pool, that purchase volume never even registers on the public order books. It doesn't contribute to the upward price pressure required to get your violent repricing. This persistent internalization acts as a fundamental dampener on any potential rally, and it impairs genuine price discovery. The stock price isn't just low, it's potentially being artificially suppressed.
Riding catalyst for 2026 is not the split or the dark pools. It is the physical product scaling, specifically the Polestar 4. The P4 is the critical Model Y fighter. It is the high-volume vehicle aimed right at the mass-market premium crossover segment. It's slated for volume production in both China and Korea, expanding that tripartite strategy.
That's a massive bet on a single vehicle's success.
The company's entire profitability path hinges on the successful market reception and rapid scaling of the Polestar 4 next year. The Polestar 2 established the brand, the Polestar 3 fixed the geopolitical problem, but the Polestar 4 must be the financial solution. If they can hit 150,000 units of P4 production in 2026, the discussion shifts entirely from solvency to margins and market share. That's the binary outcome we should be focused on.
But even the Polestar 4 carries immense design risk. They decided to eliminate the rear window and just use a camera instead. That's a huge operational and psychological gamble in a conservative luxury market. And until that P4 volume materializes and the South Carolina factory costs stabilize, we are stuck with the reality that the Q3 gross margin was negative 7.9%. And the net loss is over $1.5 billion. The market trades on what it knows, and what it knows is a broken financial structure with a near-term liquidity crunch.
So, to summarize my position, I maintain that Polestar has successfully executed the difficult geopolitical and manufacturing pivot required for long-term viability. The current stock price is a reflection of past financial damage, restructuring costs, value adjustments, but it critically fails to account for the future tariff avoidance, the IRA lease benefits, and the massive product scale from the P3 and P4 ramping up in 2026. The execution risk is undeniably high, yes, but the potential for a violent repricing if they achieve just a modest 1 or 2 times sales multiple is extremely attractive given the current valuation. It's a classic asymmetric risk-reward scenario.
And I'll summarize by saying that the execution risk is fundamentally too high when the core cost structure remains broken. That's evidenced by persistently negative margins in an intensely price-sensitive global EV market. Until the Q4 2025 earnings confirm, unequivocally, that the gross margin bleed has been stopped, this company is primarily a speculative instrument. It's dominated by dilution risk, the corporate governance concerns of the Geely discount, and the volatility-suppressing effect of dark pool trading. The material presents a binary bet, but the financial facts today mandate extreme caution.
Indeed, the source material presents this as a sharp binary bet on management's execution against some severe headwinds. The market now has to absorb this reverse split and wait for those 2026 operational metrics to confirm whether the pivot was a success or a final expensive failure.
Right. The outcome is far from decided, but the clock is certainly ticking.
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.